One. Hi, this is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and I have with me Mr. David Blatt. How you doing, David?
Hey, I'm very well. How are you?
Doing well. We've had some nice technical challenges here, and we finally got it together. So thanks so much for bearing with us. Yeah.
I'm very glad to be here. It feels like the fruits of my labor.
There you go. Well, first of all, your shirt, slay. I mean, what's going on with the shirt?
It's just like my inspiration to just get up and seize the day. So that's how I feel. When I just get up, get out there, and just try to make some deals happen. Just get my business going.
There you go. I like the shirt. I like the motivation there. So let's talk a little bit more about, I guess, how you got into real estate investing, or just into real estate in general. I mean, because your resume is impressive, to say the least. And we'll have a link to his resume and all the things that he's done. But I want to talk a little bit more about, kind of how you started, because if I'm not mistaken, you actually started as a receptionist in a real estate firm.
That's right. So I when I decided that I wanted to get into real estate investing, I was trying to figure out where my entry point was going to be, and so I spent a little time just talking to people, networking, interviewing, and I found this firm that was doing brownfield redevelopment. They were basically buying contaminated properties and turning them around. It's the ultimate value add distressed asset acquisition. And so I was fascinated by it. And frankly, what I was really attracted to was the idea of being able to buy real estate at a deal. It's just like getting it at a good price. And granted, you have to work for it.
But it's a brownfield. Okay, for those who don't know, what is a brownfield? Describe what a brownfield is.
Sure. So brownfield is the category or term of art that is used to describe properties that have been impacted by contamination. So that could be everything from just like what you would envision, like radioactive like sites, right? Those are like the extreme version. And then you'll have things like gas station sites where like the underground storage tank has leaked into the ground, or a dry cleaner where the dry cleaning solvents have seeped into the property, and things like that, so it's not as extreme where, you step on the property and you walk away glowing, but it's the kind of situation that requires by regulation some kind of cleanup. And usually there's like liabilities attached to how it got from a clean asset to what it was. And, so brownfield redevelopment is essentially the business of going in, taking these sites, cleaning them up, and just getting them back online until they're safe, fully operational properties again.
So I mean, before I guess going into the kind of how you progress from there, but what you said you were interviewing and things of that sort. You really wanted to be in real estate, or is it just that this was just one of the places that you were interviewing with to try to find a job or something?
No, so I specifically made the decision first that I wanted to be in real estate. And to me, that meant specifically being able to invest into real estate assets with an eye towards wealth building using real estate. Right. I looked at it as a vehicle to essentially create an entrepreneurial platform that could essentially solve that for me. And so I was really scanning the market and talking to people and networking with that in mind.
Got it. Okay, got it. And so you were successfily added on as the receptionist. I mean, what
Yeah.
you do? Go ahead.
I mean, it wasn't necessarily that I went looking for this job and I saw the opening. It was that I had previously met, with one of the guys who was telling me about what he did, and he happened to mention that he was looking to hire a receptionist. So after just going out, networking, interviewing around, I realized that I really want to learn this space. I want to learn how to buy distressed assets, and I want to, create, this is my on-ramp right here. I was like, but, they weren't big enough that they were going to hire someone of my qualification, and the schooling that I had gone through, but they were looking to hire a receptionist. So I came in and I said, listen, you just found your receptionist. It's your lucky day. I said, I am going to take whatever you were going to pay this receptionist. And in exchange, I want 3 things from you. So I said, I want to gain experience in the business that you're in. I want to build my network here and try to build my contact base through this platform. And I want the opportunity to earn equity in the investments that we work on together, that where I can contribute value. I want an opportunity to get a little scrape of these deals that you're doing for the work that I'm doing. And I said, I'll fetch your coffee. I'll organize your, paper clips and everything else you want done.
Okay. I was going to go somewhere else with this interview, but I've got 2 other questions. Oh no. What kind of education did you have? You had some education and training before getting in here. What kind of education and training did you have?
So by that time I had earned my law degree. I'd earned a master's in negotiation, and I had completed my MBA as well. And I was taking the bar exams around that time. I basically ended up, I'm licensed in New York, New Jersey, and California. I sat for all 3 along the way. So I was hyper educated, one could say.
Yeah. Okay. So, okay. All right. So you're hyper educated, and you said you got a master's in negotiation?
That's right. Yeah. I went to Pepperdine University.
Okay.
They had a program there for negotiation. I had taken some negotiation classes in law school. And, generally speaking, the law school format is, they teach you like cases as the basis for the law. And it's very academic, but in terms of like practical skill set, when I took some of the negotiation classes, I always gravitated to just the art of negotiation, but in terms of like having a discipline around that fascinated me. And the classes were so great because you were literally just role playing different scenarios and, resolving conflicts and whatever. So once I took some of those classes and I was able to identify that there was a full-fledged dedicated program that was very well regarded, I was all about it. And so I just continued my education into getting that master's.
So for somebody like myself, who I've done some negotiation, but I think I could use a refresher and or more training. Is there something out there right now that you like that you can say, you know what? Yeah, this course is pretty decent on negotiation. Do you have anything like that?
Well, the book that was like the Bible of a lot of the negotiation courses and really the foundation is a book called Getting to Yes. And then there was a follow-up to that called Getting Past No. Super easy reading, but it really provided just a fantastic, simple way to think about negotiating and really like the idea of moving away from positional bargaining, where you take one side, someone takes the other, and focusing behind people's positions, thinking about what their interests are, and thinking about the priorities of those interests. When you default to things like positional bargaining, you tend to think, in terms of dollars, let's say, when you're negotiating price as an example, right? But sometimes people have other priorities, like, and sometimes it's, time, certainty, certain emotional aspects. And it's just, it really, it pays to try to mine for that information to then really try to get to a deal that, works even better than what you could have gotten if you had just taken the, like, this is my bid type of a structure and approach to a negotiation, where the other person starts to become a little more adversarial and counter to where you are. So, that was always something that was referenced, and you just start to internalize certain habits. And, not to say, listen, sometimes it is about price. Sometimes you do have to position. Sometimes there is a little bit of gamesmanship involved, but, to be able to rely on that and fall back on that, I think is, just, it's been hugely helpful in my practice and just my professional development and just generally how I run my business.
So what type of law do you practice? I mean, you sat for the bar in, 3 different states, California, New Jersey, and New York. What type of law do you practice?
I like to refer to myself as a professional client of other lawyers that I hire. So I don't practice. My primary business is really on the business side of things, and it's always been. I think when I was in law school, I interned for some law firms doing transactional work and working on deals. And every time I was doing that, I found when I was like, they would hand me the contract and be like, okay, go through this painful document. I would read the document, I'd read the business terms, and I'd think to myself, I don't want to be the guy doing this. I want to be the guy doing the deal who hands this to the guy doing this.
Got it.
And it was just, and so I knew very quickly while I was in law school that my end goal here, I sat for the bar. I needed to just at least get my licenses. It was like, that was just the natural finish to having gone to law school. But I also knew, that I knew I was not going to practice. But I will say this, I think law school makes the biggest mistake that they make is that they really just position from a marketing standpoint their degree strictly for the practice of law, when if you look around at some of the most hugely successful business people in the world, they all have law degrees. And I think it's because you do pick up a discipline in your analytical skills, in how you write, in how you read, and it absolutely impacts how I think about things, how I frame things. So I don't look at it and say, oh, well, I didn't practice law. That was a bit of a waste. I could have skipped that and gone straight to what I'm doing. I actually think it contributed to my path.
Yeah. So I've quickly, we've quickly kind of gone down and figure out, why did you want to get into real estate? It seemed like you want to be that guy who's handing these cases off to someone else. Again, being that professional.
Lawyers are, they very often, it's like when the lawyer might come in and just drop some serious, convoluted stuff on you, and you're just like, I don't even understand what you're saying, but deal with this. I'm the opposite. I'm like, I know exactly what you're saying, and let's just boil this down to what this is. It can be done in a simpler manner this way. So this is how we're going to do it. I'm an acquired taste as a client. Some lawyers appreciate that I make their job easier. Some of them don't work for me after a while.
Well, because they want bill rate, right? I mean, that.
Oh, yeah. So, a lot of times I'll do some of the stuff just put together partnership agreements and stuff like that, just because, when you're in this business long enough, you effectively get, a law degree just being a professional in the business. You just do it enough times. It's like you've seen leases, you've seen contracts, they start to look, feel, and act the same.
There's a lot of boilerplate in all of them, and you can kind of, in this section, this is what's going to happen. In this section, this is what's going to happen. You need to focus on this section. Yeah. So
exactly.
So okay, we're working as a receptionist, so highly educated. We know why we want to get into real estate. We've asked for 3 things, from this job. Number 1, you need to know. Number 2, you want to, or learn. Number 2, you want to build your contact base. And number 3, you want to actually get a portion of the deal. How did that work out? How long were you there at that particular firm? And then kind of how did you progress after?
So, I wanted to manage expectations in exchange for the opportunity. So, the last thing that I added was once I feel like I have gotten these things and I have a handle on how to do this, I'm leaving. So I wanted to, just let them know this wasn't a forever situation, and not even if I got promoted, I just, my goal was I was looking at it like an apprenticeship.
Yeah.
And so I was there for about 2 years.
Okay.
And, I got to a point where, I realized, I was ready to go.
Did you pick up
So
any deals at all? I mean, were you a part of any of the
yeah,
deals? Okay. And
yeah.
you're not making a lot of money. So did you have another stash of cash where you were investing in these deals, or was it specifically sweat equity where you were a GP, LP? Talk to us a little bit about that structure and, how.
Yeah, sure. So, I mean, the investment firm itself was acting as a GP for the deals that the company had done. So I was able to participate on the GP side
Good.
on those deals. So, part of it was certainly sweat equity. And I did have a little money that I was able to put in. I mean, nothing, to like, move the dial, but enough for me to commit mentally to the fact that I decided I wanted to invest in real estate. So, I wanted to just execute that, just get accustomed to what it was about, right?
Got it.
Seeing, skin in the game and, just seeing a return on that investment. So, so that was how I did it. I mean, listen, I was very young. I had very low expenses at the time.
How old
I
were you at the time, if you don't mind me asking?
Yeah, I mean, I was in my like mid-20s.
Okay.
Yeah, so I had come out of school, and I wasn't, I never really had a high burn rate, personally speaking. So it wasn't like I needed to like live large or do
I mean,
anything.
you're in New York now, right? Or where are you
Yeah,
living? Well,
yeah.
that's pretty expensive there in New York.
I guess you acclimate to wherever you are, right? I mean, technically, I could have moved elsewhere, and I probably would have been, balling. But here, I lived within my means. Let's put it that way.
Understood.
And so it was easy for me at the time to really just be able to have the privilege, truly,
Yeah.
of working in a position that certainly was not a livelihood by any means in and of
Right.
itself. Right? I mean, not everybody gets that shot.
Right. So you were there for 2 years. You were able to participate on the GP side. You had a little bit of cash that you were to put into the deals and move on. You're in your mid-20s. So you're moving on and you're still invested in some of those deals, at 25, 27 years old, I would assume, because generally, at least what I'm seeing is that a lot of these deals, I don't know, what was the business model to, kind of fix and flip, go in, clean them up, rent it up and then leave? Or, were you into it for like 5 years or so, before you were able to cash out?
So it depended on the deal. That's the one thing about distressed assets is that it tends to gravitate towards more of that fix and flip type model. You come in, you essentially, do the rehab, whether it's from a management standpoint or actual physical property standpoint, and it's
Right.
usually a liquidation because the premium, when you're buying distressed is like, you're starting at such a low basis that what you've created, just to bring it to market, not even assuming any market appreciation, is usually significant enough that you want to get out and realize that.
Right.
So that was what the exit was. So, I did see exits
Okay.
shortly after.
Got
Yeah,
it.
so that was nice. It
Good.
was rewarding, not just in the financial sense, just to see
Quick
that
summary.
full cycle.
Okay. So after 2 years there, you went on, where did you go? How did you grow? Because I mean, I see more of your resume. You are definitely highly educated beyond just the degrees in law. But where did
Yeah.
you go after that? Where did you go after that?
So after that, I decided I wanted to launch my own platform. I focused on creating a distressed platform. I ended up running it for 10 years. This was,
What class of
years.
were you in residential? Were you in commercial only?
I didn't care. For me, it was really just about finding the deals. I was buying defaulted mortgages from banks.
Got it.
I was into everything. Whatever they wanted to sell me, I was a buyer. I mean, we're talking multifamily, industrial assets. I was hotels, gas stations, marinas, golf courses. I mean,
Now,
just naming.
were you focused on getting those notes to perform, or pretty much just getting them to break them apart?
So it really all it was really all a function of the deal itself. But I was always buying with the optionality of my exit, right? So if a borrower really wanted the asset, and they just needed a little breathing room to get things going again, then that was fine. I mean, because especially if you're a real estate operator, where you're actually working the assets to create the value you're creating.
Right.
When you're sitting in the lender's seat, it's kind of nice to take a break and watch somebody else do that to deliver your exit for you. So it wasn't too hard to make that decision. I always, the philosophy of the business, and I think that it's actually something that I carry in general, whether I'm buying distressed or not, but you make your money on the buy.
Exactly.
That's what I always say,
Period.
right? That's it. You make your money on the buy.
That's right.
So, you gotta really think about that, because, the second you buy that asset, you've got to have some margin for profit right away.
Yep.
Otherwise you're really just buying like contingent downside.
Yep.
Like
you got it right. Exactly. And it depends on the market. So right now, we're in the midst of COVID when we're talking about this. We're talking about maybe another, second wave that's coming. And, there have been people who are talking, hey, there may be keys being thrown in the street, because of some distress situations coming up very soon. Or at least that's what I'm hearing. Is that what you're hearing? And do you think that someone who may have a distressed platform or that model would be good to maybe get it up and running for this next, say, 3 to 6 months?
I would say the latter. I mean, I will say, when I ran my distressed fund, I was like, it started off onesie, twosie deals, and then, the last recession just hit, and all of a sudden the pipeline opened, and I got institutional capital invested with me, and I had a strong run through the downturn. And I dissolved the fund in 2012 when the market started to rebound. And since then, I've been doing onesie, twosie deals, because that's really what the market's supported when you've been when you look for distressed and opportunistic kind of deals. The market's just been so strong. So I've 100% noticed a pickup in opportunities being presented now. I think that there's going to be an increase in that, because the onesie twosies that are maybe a little more than onesie twosies, maybe they're threesie foursies, if that's a thing. But I think that, you have to remember that the COVID lockdown put a lot of aspects of the economy and real estate in particular into what I would describe as like an induced coma, right? We just kind of hit pause on a lot of things, where forbearances were just handed out to everybody. Right. And what is going to happen now, going into what a fourth quarter, first quarter of next year, and maybe for some time beyond that, is that these forbearances are going to burn off, and the lenders are going to have a very clear picture of who comes back from this and who just isn't coming back from this.
Got it.
So I think when they realize who's not coming back from this, they're going to just get rid of this stuff. And comparably, I do think that you're just going to have sellers, like you said, who are just going to throw in the towel on these assets, especially if their loans are non-recourse. They're just going to say, look, it's just not worth me bringing this back online right now. The amount of money I'm going to have to bring in just to get it back to where it was, and the time it's going to take to do that is just going to be too much. I'm out. So I think that is going to present some great opportunities.
So are you, I mean, you said you were doing onesie twosies after 2012. Do you currently have a fund, or are you doing syndications for the deals that you're doing moving forward?
So historically, it's been syndications for the most part, because I haven't really found enough deal flow to sustain a fund. And it's not a question of capital. I think that there is just a huge amount of capital that is chasing deals in real estate, and particularly in the distress space right now. So accessing that capital is not so much an issue. It's deploying that capital that's the biggest challenge. And a lot of people, it's like one of these grass is always greener kind of situations, right? When you have deals, you're thinking, man, I'd love to just have this big like war chest of capital to take advantage of these opportunities that I can see either now and or in the future. But by the same token, you have groups who came out of the gate strong forming these funds, and they have to deliver a performance on the fund dollars they got committed months ago, right? So every day that goes by every day that goes by that they don't do a deal is a day that they delivered a zero return on that money.
Got it.
And when they finally put that money out, even if a deal comes back and just crushes it,
you still gotta
it's got to catch up, right? So in effect, they're now in a hole. So I've always tried to avoid that. And, the other thing is I just don't want to have a gun to my head to be making bad deals for the sake of deploying money. So it's really just been to date syndications, because I've been fortunate enough to have investors that have interest in the deals that I do, that when I present the deals, I'm able to capitalize them. And I know the capital markets and the lending market very well because of all the deals I've done just trading debt, that I can access financing when I need it as well.
There's a lot, and I know you've got to get out. It's a ton more questions. So we're not doing necessarily a fund at this present time because the deal flow isn't quite there as yet. But maybe in the next 3 to 6 months, we're saying that it would be there for someone to create a fund. Otherwise, gaining access to, say, distressed funds, which seems to be your sweet spot. Are you still in that distressed funds area? I guess that's a.
So, I mean, if you're asking me if I'm, moving towards forming a distressed fund, in the near term, I mean, the direct answer is yes. I just think, and I'm saying that to address the question of whether there are going to be enough distressed opportunities presenting themselves in the market to be able to deploy that kind of capital. And so that's really what the driver is. And I do think that there are now opportunities, and I think that there will be more so. People think it's because people are bleeding, that when they think of distress, but in fact, it's a lot easier for a bank to write down a loss when the overall health of the bank is strong. And when I compare it, having run my fund through the last recession, where all the banks were essentially just by the day just dying, right? FDIC was coming in, taking them over. They weren't letting go of their defaulted loans. I had their defaulted loans. I mean, just to give you a contrast. And I would talk to the bank and I'd say, listen, I'm going to buy this stuff from you. I'm going to deliver cash to your books. It's worth X. We both know it's worth that now. And they said no. And then the next day, the FDIC would come in and take them over. And the reason why it was harder to do deals then and why it's different now is because capital availability and the health of the banks is so much stronger that it's so much easier to take a haircut on a few loans and take that money and put it back to work to do the thing that they do as a business, which is make money on money.
So then, oh God, there's so many questions. This is great. I've done one defaulted note, and it was about $600,000 and about probably 30 doors, and it was a combination of single family and multifamily at one time. And, so will you be, I won't ask that. I want to leave you your unique selling proposition. So you're going after the banks rather than going after, say, the sellers, when you're attacking this whole situation.
Usually that's where I like to transact,
Okay.
because not to say that I haven't transacted with sellers that are in a position that they need to exit, and
Sure.
I'm doing a couple of deals like that right now where the sellers just absolutely have to sell, and I'm their exit. The distressed transaction, the traditional transaction is, taking like classic economics,
Yeah.
right? The equilibrium point of the trade is where supply meets demand, right?
Right.
And where the seller wants to get the absolute highest price, the buyer wants to get the lowest price, and the strike price is right in the middle, right?
Right.
Where in distress transactions, the way that it's typically working is that the buyer gets the lowest price and the seller, they just want out. They want
Yes.
certainty of execution and an exit. And if you can deliver that, they don't necessarily have to take every last dollar, because once you go into the red on a sale, right? Once you're already selling for a loss or something lesser than, what was value, and you're just looking to cut losses, at that point you become far less sensitive to whether that loss is like this much or that much,
Right.
to
You're gonna
some
run
degree,
out at
right?
some point in time, and if you're in a stronger position as a bank, it's just you're gonna recover from it. So
Oh yeah, it just washes over quarter
yeah,
to quarter. And I would say even more so, if a bank goes and announces in the fourth quarter of 2020
yeah,
that they took a loss of this many real estate loans, you know, is anyone really going to ding them too hard and say, you're a bad bank, you mismanaged? No, they're going to say, oh yeah, we were just in one of like the, you know, historic,
as long as we don't have
pandemics,
to bail you out again, right? I think
Right. Okay, so we don't have to bail you out. You're in generally good financial health, and you cut your losses on the dog loans that you had on your books so that you could take that money that you did recover and then lend it out again. So, I think that it's just going to present the opportunities from there. So that's why generally I'm primarily targeting and dealing with the lenders over a seller, but not exclusively.
got it. All right. Now I've got about 3 minutes left of your time, and I know I've got to get you out so you can get to your next thing. So what are you doing right now? I think you had about three separate business lines you were in, and then finally, how do people get in contact with you? That might be the simplest one to answer first. But what do we got?
So,
Pick your lane.
I'm all right. I'm active on my socials. You can absolutely, LinkedIn is really just a very easy way to connect with me. Um, I stay active there, and I'm always on top of the industry. Just so that's the easy one. The three lines of business that I'm currently in. So principally investing, as I mentioned, into the types of opportunities that we just spent talking about. I also have an advisory arm to our business that's focused really on debt solutions to borrowers and lenders. So with borrowers who are looking to think about how to finance their deals, or need help capital structuring, we're working with groups like that, to help them both think about the best way to structure and then obviously to access that debt capital for their projects. And then the third line is it's an online marketplace platform called BankSell, which is really lender to lender that I created so that lenders could buy and sell loans from each other, non-performing loans, performing loans, participations in loans. It's just really, for me, I've just been in the debt space for so long that I know the players, I know the
Yeah.
structures, and so I'm always thinking about just the most efficient way to structure capital for real estate transactions, what the drivers are, And this goes back to the whole concept of the negotiation. I spend a lot of time understanding like what the capital makeup is of a lot of like even lending groups and investment groups, right? What's their driver? What's their interest?
Yeah.
Right. And then I know who to go to, right? A lot of people just think about, I need money, but again, that's more of a positional approach. But if you know that this fund likes this kind of asset and they have a fund they just raised, they got to get money out the door, you want to talk to them first. It's an efficient execution.
Well, listen, David, I thank you so much for your time. Thank you so much for joining us. We're going to have to talk again. There's too much stuff to talk about with David Blatt. And if you want to reach out to him on LinkedIn. Thanks again, David, for your time.
Thank you. Thanks for having me.